Joseph Hogue here. Thank you for joining us for another live stream, another Beer Money Sunday. I've got mine. I hope you got yours, whether it's an adult beverage or whatever you're drinking right now. From all over there in the nation, thank you for being here again. Love doing these live streams. Just a chance to connect with you out there in the nation, take off the tie and relax a little bit, and have these Sunday chats about where we see the market going, some opportunities and some risks going forward. Let me know where you're coming at from the nation out there. I see a lot of the OGs in the Bowtie Nation, the citizens there. Ambrose from New York, always here. Thank you for that. I see a lot of you from Michigan. Anthony, Christine, a couple from Europe, Andrew and Romania, Germany. Great to see you here. Again, love just being able to connect with you personally on a little bit more personal, face-to-face level than we get with the regular videos during the week. So again, thanks for being here, and we're gonna get to it because we've got an important video for you this week, this Sunday. Tech stocks and a lot of those growth stocks, those high PE stocks have been crashing. And you know this because you've been watching your portfolio. And I know a lot of people are maybe a little bit too exposed to those tech stocks in their portfolio. They have 30, 40, 50% of their money in those. And it's been painful. But not all of them have actually been crashing. There's actually some tech stocks and some sectors that have been doing really well over the last few weeks, and they could continue to outperform as the rest of the tech stocks and that growth stocks theme, kind of faces a little bit of trouble this year. So I looked at the best ones to own last year, the ones that worked last year, which ones are selling off this year and which ones aren't, to really find those trends, not just the specific stocks, but kind of the trends in tech stocks and those other stocks to look at this week. So we're going to look at that. We'll have a Q&A after that as well. Love answering your questions and just being able to connect with you out there. Before we get started, I wanted to invite you to sign up to get the free report I've just started putting out with the Motley Fool. It's in partnership with the Fool. And basically what this is it is the five biggest stocks in my own portfolio. Okay, a lot of you that have been following the channel, we just finished up our Big Ideas stocks, right? ARK Invest put out a Big Ideas report towards the beginning of the year. The 15 major trends, disruptive trends that they're following over the next 10 years, 15 years. And it was a great report, but it really didn't highlight a whole lot of stocks, specific stocks to take advantage of these trends. So we did 9 videos on these 15 trends for stocks that were going to benefit from those trends, those long-term disruptive trends. We just finished that up, but I realized I didn't do a one all-encompassing video where I showed the stocks that are going to benefit from multiple trends that are really going to drive drive higher returns from this whole idea, this whole disruptive forces idea. So I wanted to put out a report, partnered with the Motley Fool to do that, and it's completely free. You'll see here, I put the link there in the live chat, pinned it to the top, and I'll put it in the comments and in the description below. Click through and you sign up, you put in your email address, and boom, you get it free. No obligation. Motley Fool is going to send you some emails, but you don't have to sign up. I actually do use the stock advisor on Motley Fool for research and some different ideas. But again, I just something I wanted to do for you for free. Show you those 5 best stocks those 5 biggest stocks in my portfolio that I'm hitting on as many of these trends as possible. So go ahead and sign up for that. Again, no obligations, totally free, and you'll be supporting the channel. So I appreciate that. Look for that link there in the live chat or in the description below. Now I want to get started though, because again, this is a big topic for a lot of people out there. I know a lot of people that are heavily invested in tech and are seeing some real red in their portfolios over the last few weeks. Even though we did see a big bounce back in tech over Thursday and Friday of the last week, tech, it was up almost 2% Thursday, I believe, and 2.3% up Friday. But that still, that didn't really change the trend, because over the whole week, tech was still down. The Nasdaq was still down 1.4%. It's still, kind of rough over the last 4 months, over the last 5 months this year, and the trend might not be any more favorable through the rest of the year. I'm going to talk about that and show you, some reasons why some of those tech and growth stocks might not be doing well for the rest of the year either. Just a heads up, next week, this week actually, we've got some videos coming up actually did inflation stocks last week. Great theme to be watching for. Obviously, we got those CPI, those consumer price inflation numbers on Wednesday, as well as the PPI, the producer price index for on Thursday, showed huge jumps in inflation. Okay, and what's obviously the consumer price report, the CPI, got more attention because everybody focuses on what consumers are paying, but more importantly was the PPI number on Thursday that also showed that huge jump in inflation. And because it's the producer prices that are going up, those are going to be passed on, and it just pretty much guarantees that we're going to see even higher consumer inflation numbers over the next few months, over the months ahead. So, if you think the sell-off on Monday, Tuesday, and Wednesday was bad on those CPI numbers, just wait, because it's going to get just as bad in June, July, and August. Okay, as those consumer prices keep going up, as the producers pass along those costs. So be watching for that. Next week, this week actually, we've got a portfolio review for our 2021 Bowtie Nation portfolio tomorrow. I'm going to be reviewing the portfolio, show you how to review your own portfolio, and kind of rebalance that and make sure you're not too exposed in any particular sectors or themes. Also on Friday, got one that was really cool. Looked at the average $100 portfolio. So we have the stock tracker, the spreadsheet that we have on the channel there. And it shows me a lot of, the smaller portfolios, the retail investor portfolios that I look at. So I was able to compare that, the retail investor portfolio, to the millionaire's portfolio, the $1 million portfolio, with some research from BNP Paribas. And it's really interesting being able to compare these. And I'm actually going to show you that on in Friday's video. I'm comparing the $100 portfolio, so the retail investor's portfolio, with the millionaire's portfolio, how they're different, how they're similar, and what that means for your money. But let's get to it here, because I want to get to this. I want to do this tech stocks theme here, and then get to your questions. And now this is kind of the tech crash part 2, right? Because we saw the same thing in February, but it's a little different now. In February, the reason why tech stocks sold off was because of higher interest rates, right? And we talked a lot about this, how stocks are valued by their future cash flows, what you can expect in the future for those cash flows for those stocks. And the way you value them is you discount those into a present value, and the discount rate you use is going to determine, or is going to be based on, what interest rates are out there right now in the market. Okay, so as interest rates go up, those future cash flows get discounted lower into a present value. And so any stock with very high cash flows expected in the future, you've got some stocks like you've got Apple, you've got Disney, you've got GE, all those stocks, the traditional established companies that have a lot of their cash flows right now, present value cash flows, don't get discounted quite as much, because they've got those steady cash flows spread out. Whereas a lot of those tech and those growth stocks that you're expecting huge cash flow in the future, maybe not quite so much right now, they're not making quite as much money right now, but in the future they're expected to post much, much higher cash flows. Well, depending on how far out into the future that is, and how much you're discounting that, because you discount it for every single year on those interest rates, then that drives down that present value. Okay, so that's why stocks sold off in February. The interest rates just jumped, and so we were looking at a lower present value. Lately, it's a little bit different though. Related but different. Okay, lately it's been more on those inflation fears, and a lot of this goes back to what we've seen in the market over the last year. I mean, the Federal Reserve has pumped about $4 trillion into the economy. The government has pumped about $6 trillion into the economy. And we looked at a lot of these numbers in last week's inflation stocks video, where basically the amount of money in the system has grown 26% over the last year. Okay, that's more than any year since 1943. It's more than 2 years combined in 2008, 2009, when the government was trying to prop up the economy. So it's just a massive amount of money pushed into the system, and invariably it's going to cause inflation. Well, what investors are looking at with that is part of the impetus, part of the reason why stocks have been going up is because the Fed has pumped this money into the system, has driven interest rates way down. And you get that, of course, you get that valuation idea with interest rates, but they've also pushed all that money into the economy. Well, what happens when inflation goes up is the Fed has to react. The Federal Reserve, the central bank of the U.S., has two mandates. Okay, one is full employment, and they measure full employment by basically they talk about 3 to 4% natural unemployment rate. Okay, that's just the unemployment rate that we're going to have no matter what. There's always going to be some people unemployed, for one reason or the other. So they try to get the employment number down to there, right? And right now it's right around 6%. So they're a little bit higher than full employment. That's expected to actually drop to around 5% or less here into the 4% in the end of this year. So full employment, the Fed's trying to get that. They're also trying to get price stability though. So, and that's kind of the other side of this coin with this growth story coin here. They're trying to keep inflation modest. Okay, right now the Fed has a target of about 2% inflation. That's the amount of price increases that they say that the economy can withstand every single year, 2% inflation, without really slowing down growth or hurting savings, right? Because anyone on a fixed income, getting a fixed amount of money like Social Security or bond rates, any fixed income kind of people or savings, they're hurt by too much inflation, right? So the Fed kind of tries to balance these, right? It can push money out in the system. It can lower rates to zero to get that employment number, the unemployment down, right? To boost employment, boost growth. But that's also going to boost prices. It's going to boost inflation. So it has to kind of moderate how much money it pushes out into the system and where interest rates are, so we don't get too much inflation, but we have good employment numbers. Okay. And what happened, of course, is the Fed is pushing out all this money, trying to get employment down, but we're seeing inflation come up. So, the Fed, all the people of the Federal Reserve, the governors, the board members there are saying that inflation is temporary. We're going to have a big spike here in the summer, but it's going to settle down and we're not too worried about it. They're going to let inflation go a little bit hot, 2.5%, maybe even up as high as 3% for a little while before really worried about it and bringing that money back. And investors are starting to kind of be skeptical a little bit. This is something we've talked about in the Bowtie Daily, our daily newsletter over the past few months, been talking about on live stream over the past few months, is that, we know inflation is coming, but the Fed is holding to this message. And for the most part, the economists and the market, the investors are believing them that, okay, the Fed is standing pat. They're not concerned about inflation. They know inflation is going to tick up here in the summer, but they think it's temporary, so they're not worried about it. Well, the problem is that, even though we're expecting it, and like we saw on Wednesday, we knew it was going to be high. We knew the inflation numbers were going to be high, and you saw stocks start selling off before that. But when it did come out and it confirmed that, and it was even higher than expected, then there was part of the market that just started saying, well, you know what? The Fed's saying this, but do they really believe it themselves? When is the Fed actually going to have to start bringing back some of this money? And the Fed is still juicing the economy with $120 billion a month in buying different bonds, buying mortgage-backed securities, mortgage-backed bonds, buying treasuries, pushing more money out into the system. And so, a lot of investors have still started saying, hey, I know the Fed is still saying that it's going to be accommodative, keep rates low, and keep pushing money into the system. But as inflation does get hotter, then they're going to have to change their tune. And that's what the markets are betting on and looking at here over this last week, and why stocks still off. So, strikes me as a little bit more dangerous, a little bit more pervasive shift from tech stocks into cyclical, into materials, into other stocks than what we saw in February, right? So now you're looking at not only are higher rates a danger for tech stocks because of that valuation, you're looking at inflation is dangerous for tech stocks and high growth stocks. You're looking at just that general shift away from what worked last year into what's working this year. So you've just got many headwinds, quite a few headwinds and things that could go wrong for tech stocks. This sell off the pain might not be over yet, and even if they don't crash, I can still feel like that if you're overly exposed to tech. Something we saw in February that wasn't necessarily a crash. I mean, even at the lowest, even at the worst in February and March, then the Nasdaq, the tech-heavy Nasdaq index, was only down about 9-10%, right? Which is a correction, but it's not quite a crash. Well, a lot of those tech stocks were down 20, 30, and 40% and more. So, if you're in exclusively in these high growth, these tech stocks, the things that really worked well last year, then it felt like a crash, even though the rest of the market wasn't necessarily crashing. Okay. So, and again, I expect the inflation to keep going throughout the summer, especially, and interest rates should still continue to rise. So that's all going to kind of weigh on tech stocks. And I mean, we can look at uh, some of these stocks. Okay, obviously, Tesla's the big one here. A lot of people love Tesla, and it did great last year, 700% rise, down 33% since year to date. Right here, peaked right around in January there. One of mine, one of my big ones, Fastly. We recommended Fastly around $20 a share. It was November of 2019. We started getting into Fastly. I highlighted it on the channel there, and it went up as high as $120 a share. So it just jumped last year. It's a content delivery network. So basically, it just means that it helps deliver the internet to you faster, the internet and streaming. Obviously, with streaming services booming last year, then everyone was pushing into Fastly and bid that up to 120. Now it's down to 42% or $42 a share. So still above where we originally started buying it at in 2019, early 2020, but down 64% in those from those peaks in February when it was, the the ARK Innovation Fund, and a lot of these, I own some shares in the ARK, the Innovation Fund there. I own shares of Fastly still. That's a long-term hold. So, just because these are falling, doesn't necessarily mean that you have to sell out and they're gonna cause you more pain in the future. These are good long-term, very long-term bets. But you have to be ready for that pain. You have to be ready for what's potentially coming for the rest of this year, and that. And just to show this to you, I just want to show you. Let's look at the ARK, okay, because that's kind of the the poster child for these high growth, high PE, disruptive companies that really did so well last year, but are getting slammed this year. Okay, so you see the ARK Innovation ETF here. It's about 40 to 50 stocks, Tesla, Teladoc, Fastly, a lot of these high growth, high PE names, these tech stock names that did so well, but are crashing now, down 34% since February. But if you look at this, and you see this in pretty much all of these stocks, okay, this is why I'm showing ARK, because it's pretty much the poster child for these, but we can look at some of these others. And I mean, you see, we can look at the max here. You see, ARK 2015, okay, $20 a share, and it did pretty well. I mean, doubling by 2018, doubling in 3 years is pretty darn good. So it's a strong growth fund, right? But something just happened last year. Right around April of last year, after we got out of the big crash in March of last year. I mean, this thing just went exponential. From $60 a share up to 156 by February of this year. I mean, it just went exponential. You look at some of these other ones. We'll look at Teladoc, okay? And Teladoc is that virtual healthcare. I own shares of Teladoc. It's a solid company, and you can see, yeah, it did okay, for the few years up to last year. But then here in starting of last year, just went exponential. And you see this same trend, I mean, all you out there in the nation, I'm not really a technical analysis charting kind of guy. I don't think you can follow charts and patterns and always, beat the market. But sometimes you just got to look at the charts and say, I mean, it's kind of obvious what's going on here. Okay. Last year, beginning of last year, January, March, April, when the government was pushing all this money into the system, pressing down on interest rates so hard, something happened. Something happened to basically break the market, okay? And you've just got an artificial explosion of a lot of these high growth tech stock names, right? And they just went exponential there. And if you look at, in the past, stocks just don't do that. So I think a lot of investors were kind of spoiled last year into thinking that this is normal for stocks. This is how stocks normally react and how stock returns normally work. You double your money every few months, and that's just not how it works. So as we get back into more of a normal economy, more of normalized rates, normalized inflation, things like that, then you got to kind of reset your expectations and think about what that means for some of these stocks. Okay, so if you're as you're looking at these stocks, I mean, like again, I own shares of Teladoc. I think it's a great company, a huge future in that virtual healthcare space, as well as health information systems, things like that. But one, don't expect it to do this every single year. Okay, it's not gonna triple in price every single year. And you got to expect some give back. You got to expect the shares to come a little bit further down into reality, and then until they can start giving you that good long-term return, that good annualized long-term return. Okay, but there are some stocks that have actually done really well. So I want to talk about where these are, how to find them. Some of these stocks that are also great long-term plays. Actually, one of these is in that top five stocks in my portfolio that I own, and you'll be able to see that with the link that I pinned there in the comments. But it's just some ways to find these. And first, you got Salesforce. Okay, so Salesforce.com started out as purely a human resources kind of company, but has really kind of evolved into a conglomerate of different HR tech ideas. They've got stuff for sales, marketing, human resources. So it's really an innovative company across the B2B spectrum. It is down 12%, from the peak there in February, but 12% isn't bad when you're considering some of these other stocks are down 33, 64%. 12% is actually pretty damn good. And if you look here, it didn't quite go. It did pretty well last year, actually. I mean, it went from around 174 up to $272 a share. So not quite double there, but still did really well last year. And it hasn't done too badly this year either. It's held on to a lot of that, and that's what you want to do. You want to look at a lot of those stocks that did well last year. I mean, they can do well in that growth atmosphere, but when the economy comes back down to normal, then you don't quite get the sell off. You don't have to give back a lot of your gains, a lot of your returns that you saw in the past there. So I think what we learned from Salesforce here is that you can have some of those long-term disruptive trends. Okay, again, Salesforce, one of the best beneficiaries of these disruptive, these big ideas trends that we've been following on the channel. Things like AI, things like digitization, things like that. The work from home, telecommute kind of idea. Salesforce is also going to benefit from that, from its acquisition of Slack that's closing later on this year. So it's still benefiting from that growth theme, from those growth stocks theme, but it's not. It's more established. It's still got those near-term cash flows, right? So what we're seeing is that the valuations aren't being discounted quite as much as interest rates rise, because it's still got those cash flows, those near-term cash flows to help support the share price. Okay, so Salesforce is a really good one, really good example of tech stocks that have come down a little bit but aren't crashing and are going to do very well into the future. Another example of this, I think, and a really interesting one is Akamai Technologies, right? And this is interesting to me. This is actually up, okay, or basically flat. Well, let's look year to date. Okay, this one is just down about $4 out of 117, so a little around 3%, down 3% from its peak in February, but has really rebounded from that February-March sell-off. Okay, and it really didn't see much of anything over this last week when the rest of the market was down 1.5%, 2%. And it's interesting compared to Fastly because Akamai is also a content delivery network, right? That's just a way of saying they help bring the internet to you faster, to customers faster through streaming, the streaming services, internet content, all that. They help deliver it. It's the delivery system, right? So it's interesting that Fastly is down, like we saw, about 64% since its highs, whereas Akamai is only down a few percent. So very interesting idea there. Proves that you can be in some of these high growth themes, so that content delivery, that streaming theme, and not lose half of your investment in that. Again, I still own shares of Fastly. I'm going to hold them for the next 10 years. I think it's a great stock, and I think it makes it back up to that $124 price target, which would be a threefold return. A threefold return from here. If you're getting into the shares now. But you can also get into that theme, into that content delivery theme through Akamai, which isn't falling as much. And again, a lot of this is, I think, Akamai is more established as an older company, so it's got better cash flows presently, better present cash flows than than the future cash flows that everybody's looking at for Fastly. Okay, so it's just part of that valuation idea. What I also saw is, and this is one way, is you can one way to find some of these is you go over here, go to the sector tracker on Spider, and all you out there in the nation, you're going to recognize this because I use it constantly. I love this resource. This is the sector tracker on sectorspider.com. Okay, so sector, SECTORSPDR.com. Okay, sectorspider.com. You go over here to tools, and they got the sector tracker. Correlation tracker is also a really a nice tool to use to see kind of how your investments are correlated, whether they're all going to go up at the same time or all going to go down at the same time. But we'll use the sector tracker here, and it shows you the 11 stock sectors, sectors of the economy. All these stocks within each sector produce a similar, a similar need, a similar service or product idea, and then you've got the industries within each. But then, and you can see, 1 day, 5 day, you can track how each of these sectors is done versus the S&P 500 index over different time periods, a month, 6 months. Okay, so let's look at this and see, really, okay, so over the past month, this gives us a good idea of during this current trend, this recent trend that we've seen, this tech sell-off, growth stock sell-off in consumer discretionary, communication services, have all kind of underperformed the market, right? Technology is down 3.5% over the last month, while the S&P 500, that broader market, is up 1.2%. Okay, so if we want to find ideas in here for tech stocks or tech groups that that are outperforming, that are now doing better than the rest of tech, then we can come in here and we can click through some of these to see the stocks in those sectors. So if we click through to technology over the past month, we can see which stocks have done well. We can change this percentage change to the drop up, which shows us which have not done well, and we can kind of look at that. And what we see is a lot of these stocks in business services and business networks, have done really well over the last month. Okay, so you've got you've got Motorola Solutions, you've got IBM, which it's crazy to say that IBM has actually done better than the rest of the tech stocks market, because it's been a dog for like a decade now. But IBM is doing really well. You've got HP Enterprise, Cisco, all those established B2B, business to business tech services that have done really well. And of course, I think a lot of this is just the idea that last year it was the consumer tech that was doing so well. Consumers, people locked down into their houses using technology, using the internet and those services so much. Those stocks did really, really well. This year, it's really more of the business services. As business starts coming back, as they start renewing those subscriptions to their business services, their business technology, those are going to do better. Okay, so again, you look at companies like HP Enterprise, Cisco, IBM, a lot of those, right? You can also look at gaming has actually done really well, and we can look at that's going to be in I believe consumer discretionary. We'll look at next, but let's stick with tech for a little bit and look at what hasn't done well. Okay, so you got In-Phase Energy, you've got some of these in. Looks like some of these in the alternatives in chips. Chips have fallen back. You've got Intel there. You've got Skyworks Solutions. Those chip makers, those semiconductor makers, obviously, hurting on the storage or on the shortage in chips there. I do think eventually that's going to turn. That chip shortage is going to turn. These companies are going to be able to turn that around with new production and things like that. And chips, the demand for chips is just growing exponentially. Okay, why we have a shortage? Part of the reason why is because we have such a huge jump in demand on semiconductor chips. The brains of any technology is those semiconductor chips, right? And now they're going into, besides just phones and your computers, they're going into your toaster. They're going into traffic lights and everything around the city. Everything needs that Internet of Things, everything needs a chip. And so we're having a shortage there. But I think, a lot of those chip companies are coming into value territory now, and you can start, picking those up on the long-term hold. Let's look at some of these others. So consumer discretionary also has done really badly over those last months, down 3.7% over the last month. And if you look in consumer discretionary, things like gaming have done really well, right? Electronic Arts, Activision have done well over the last year or over the last month. And part of that is just that trend in gaming is really one of the big disruptive trends that we're looking at. One of the things that we watched on that Big Ideas report, and the fact that they're just now starting to monetize that gaming. Okay, in the past we've been monetizing gaming through ads and stuff like that, but not nearly to the point of other video content and other media content. Okay, so what ARK Invest was saying in that Big Ideas report is that we're moving into a period, an era where gaming is going to be much more monetized. Okay, through through product promotions or ads and stuff like that, and you're really going to see it come through in a lot of these gaming stocks. So Electronic Arts, Activision, other stocks like that. So that's held up pretty well in the sell-off. You also see some of these other names. Domino's, has done really well on the continued strength in that in that delivery space. One thing that I've been looking at is these the auto parts stores, right? Advanced Auto Parts, O'Reilly. You got both of those, 8%, 7% outperforming over this last month, and really this trend should continue. A lot of those automakers are shutting down production because of the chip shortage. A lot of the car rentals, you sold off all of their inventory last year because their stocks were crashing, the business model was crashing. So now they are dangerously undersupplied for cars. They're buying up cars now, as well as all that, and car prices are booming. Okay, car prices were up 10% year over year in the last week's consumer price index. Right, one of the highest inflation months they had seen in history for cars, rental cars, used cars, anything like that. So what's important there is obviously people are going to be keeping their cars longer because car prices are going up. And so auto parts stores are doing really well in that. But you can just look through some of these other ones. What else did we see? We saw a lot of the things that did well last year. Etsy. Tesla is obviously there for biggest drops. Some of these, though, I think you can look at some of these and see an opportunity, okay? Because, I think a lot of these consumer discretionary stocks, the retailers, the resorts, the gambling, a lot of these stocks were bid up, since November through really February. A lot of these saw double-digit increases in their stock prices, basically on anticipation of an economy reopening and more consumer spending. But it have given back some of that. The market basically bought the rumor, sold the news, right? So as we start reopening, these stocks are coming under pressure a little bit. But I think I think you still got some opportunity in these stocks, these reopening stocks. You've got Las Vegas Sands here, MGM Resorts, Bookings Holdings. You've got Marriott. A lot of those stocks that are going to benefit the most from travel and reopening and that kind of thing, I think they're going to get a second wind here over the summer. I think a lot of these, a lot of the consumer spending data, a lot of the consumer spending numbers and the retail sales numbers are going to surprise to the upside through the summer, and it's going to bring a lot of these consumer discretionary stocks back up that got hit over the last, over the last month. So that's just one way of kind of looking at these, looking for different ideas in these sectors to maybe play tech stocks that aren't crashing, as well as other opportunities. Okay, so again, you go to the sectorspider.com, you look in each sector, and you can see which which stocks have done well, and you kind of see trends in them, right? You see which stocks out of which industries are doing well. So here again, consumer discretionary, you see Genuine Parts, you see Advanced Autos, you see O'Reilly. So all three major auto parts stores. Okay, where's the trend there? Is it going to continue, and how to play that? You see within tech again. Within tech, you see the winners here. You see these large established B2B business to business companies like HP Enterprise. You see International Business Machines, IBM. You see Motorola. You see Cisco. And you say, okay, obviously these tech stocks, these tech companies that are serving business tech needs are doing well. Is that going to continue? And it looks like it probably will. So you kind of position in those. Okay. All right, so now I want to open it up to questions, and I see a lot of people already been talking here in